Now for our ETF Spotlight, we continue to watch financials trade deeper into the red post-Fed, although trying to bounce a little bit today. The group down more than 20% from the recent 52-week high back in January. S&P financials are, that is. Regional bank ETF, the KRE, on pace for its worst year since 2009. Just about flat today. Joining us now to talk about the sector, RBC Capital Markets bank analyst Gerard Gassidy. Good morning, Gerard.
Good morning. How are you?
Pretty good. I wonder what you say now at the end of a year where the bullish case for banks was really laid out for us right there. Fed hiking, economy's pretty good, loan growth, buybacks, and it didn't work. Is it just the same story at cheaper valuations, or is there something else we're looking for here?
No, you're bringing up a very good point. It's been a very difficult year, particularly the last 8 weeks for the bank stocks. They've been hit hard. It actually reminds me of 2011. When you think back to 2011, from February to October, the bank stocks fell 40%. And the reason they fell that much was, you might recall, Europe was in a recession. Everybody thought the U.S. was going to double dip and enter a recession. Credit was going to be a problem for the banks. Obviously, that did not happen. From the October lows through the end of 2012, the stocks are up 52%. I think we're setting up for something very similar to that. So for next year, because of the fears of rising rates, the economic slowdown, the global slowdown, I think it's overdone in the bank stocks. As you pointed out, the valuations are very cheap, and that's why people should be looking to buy bank stocks today.
Whether it's a driving factor or not in the bank performance, it seems like the flatter yield curve is kind of smothering bullish psychology in the group. How can the stocks work if, in fact, this is where we're at with the yield curve?
No, that's another very good point. The flatter yield curve works against the banks. But let's imagine if we're sitting here a year from now. I bet you a year from now, the Fed will be finished raising the short end of the curve, and there'll be talk about cutting short rates. When you look at the last three tightening cycles, 94-95, 99-00, and 04-06, 6 months prior to the last Fed funds rate increase, the bank stocks start to go up. And the reason they go up is because people realize that the flattening of the curve will end, and that the Fed will start to cut rates, helping the net interest margin. So if you think the Fed's going to be finished by June of next year, this could be the bottom for the banks.
Gerard, it's David. Do the bank stocks, for the big guys in particular, the ones that rely on the capital markets a lot, do they already reflect what is clearly not going to be a great quarter? You know, whether it's fixed income or even equity capital markets, just in general lack of activity. This has been a tough quarter, but are they already accounting for that, do you believe?
I think the two particular investment banks, Morgan Stanley and Goldman Sachs, do. David, you're right. This is a really tough quarter. I mean, when you think about ECM, DCM, very weak. Trading is not going to be good for any of them. The universal banks obviously have come down, but they have more diverse revenue sources, so obviously the pain won't be as severe for them. But the two investment banks, I do think it reflects it, but we have to wait until January to see what the fourth quarter results will be, and we expect they're going to be really rough. And then the question is, when will the markets turn? There seems to be a building up of the IPO pipeline, which will be good for ECM, possibly in the first quarter of next year.
And finally, Gerard, I mean, there seems to be a little bit of punishment of the bank stocks because of this generalized fear of corporate credit risks, whether it's leveraged loans or other areas. Is that even an isolated worry in some of these banks at this point?
The credit outlook is still very strong for the banks, and it is very appropriate to be concerned about leveraged lending, because we know from past this is going to be a problem area in the next credit downturn. And the credit downturn, of course, is going to be linked to the recession whenever that comes. But when you take a look at leveraged lending, the vast majority of it is being done outside the banking system. That doesn't mean the banks are immune. There's going to be that second derivative issue to worry about. But right now, the direct linkage to most of the leveraged lending is outside the banking industry and the so-called shadow banking industry. That's where the problems, I think, will be most severe. So for the banks, there will be some challenges, no doubt about it, when that leveraged lending starts to turn south. But we don't see any evidence of that happening yet. We really need to see an economic downturn for that to be a problem.